This concept will help you improve your entry models using the ICT concepts. I welcome you back to my channel. This is Forex Uganda, back with another episode of PDRA Matrix. This PDRA Matrix will help us elaborate more about the entry zones and the exit zones. Remember traders, we want to buy something which is cheap and sell something which is expensive. Meaning we want to buy from the discount and sell from the premium. That's why I have brought this episode to help you break down and elaborate more. And soon I'll dive into the charts to show you a better demonstration of how to identify the premium zone and how to identify the discount zone. Meaning, if you can identify the premium zone or the discount zone, you are just remaining with only one thing. Where are you going to buy from and where are you going to sell from? Remember, we are selling from the premium and buying from the discount. As a trader, we want to buy something which is cheap and sell something which is expensive. Meaning this brings in the premium and discount zones. Or you have to be able to identify the premium and discount zones of a specific market or of a specific chart. As me, for example, I buy from the discount and sell from the premium zones. Meaning, after identifying my premium and discount zones, I just take another initiative to identify where am I going to buy from the discount and sell from the premium. We buy from the discount PDRs and sell from the premium PDRs. Usually we identify our premium and discount zone using the interbank dealing ranges, which usually vary at different time frames. On the 4-hour time frame or on the daily time frame, we can usually take the previous day's high and the previous day's low. On the very higher time frame, we can take the interbank price delivery algorithm data ranges. Those are the 60 days look back, 40 days look back, and the 20 days look back. When we break down to the 15 minutes or the 1 hour or the 5 minutes, we can take the sessions high and the sessions low. Meaning wherever we sweep out any high or any odd low, could it be the previous week's high, could it be the previous day's high, could it be the Asian high, meaning we have formed a new range. Depending on whichever time frame you are doing your analysis, you may be a swing trader, you may be an intraday trader, you may be a scalper. Meaning if I'm an intraday trader or I'm a scalper, I'm waiting for them to take out the previous or the Asian high so as to form a new range. Meaning I will have gotten a new range where I would just take it that my buy side liquidity has been taken out. As I told you earlier on, if we take out buy side liquidity and sell side liquidity, we have formed a new interbank dealing range. Meaning, whenever we form a new interbank dealing range, now we are looking up for the premium and discount zones. Is the market on discount? Is the market premium? If the market is on discount, we are buying it to the premium. If the market is on discount, we are selling it to the discount. When adopting this concept, you must be very capable to identify a swing high and a swing low, as you can clearly view them on my chart. For today's episode, I won't talk about the interbank dealing data ranges because they will also need another episode of elaboration. Just bear it in mind that they are also very useful tools when identifying the premium and discount zone. Why is it important to identify the premium and discount zone or to use the PDRA matrix? Remember, we are trading with an algorithm. An algorithm tends to seek for liquidity zones. And remember, our first liquidity is lying on the internal range liquidity and external range liquidity. Internal range liquidity, those are the PDRA matrix, which are the propulsion block, fair value gap, order block, mitigation block, rejection block, breaker block, and many more. Then external range liquidity lies on the odd highs and odd lows, which we have been talking about earlier on. An algorithm seeks for PDRs for price delivery. An algorithm also rebalances and creates imbalances. Remember traders, only use the available PDRs. Don't look for the PDRs which happened in 2002, you were not there or you were not a trader by then. Use the available. My 4-hour order block is here. I'm waiting for mitigation so as I may sell or buy. Could it be a premium PDR or a discount PDR? Use the available PDRs. Most of the PDRs disturb traders, or most of the PDRs become a problem for trader identification on the chart. I'll just elaborate a little PDRs. This would be the fair value gap and this will be the order blocks because they mostly appear on charts. The order blocks and the fair value gaps. You may find some traders or some ICT traders only trading the fair value gaps and the order blocks. When the market is in the discount order block, I buy. In the premium order block, I sell. In the discount fair value gap, I buy. In the premium fair value gap, then I sell. Let's start with the fair value gap. The interbank price delivery algorithm not only engineers liquidity in the market by moving price, but it's also designed to offer fair value gap for the sellers and the buyers. This is also based on the IPDA's market efficiency paradigm logic. You will find in some cases that the interbank price delivery algorithm reprices too quickly in one direction, leaving inefficiency in the other direction. In the order of the IPDA to maintain its fair value gap parameters, it will reprice to rebalance the inefficient price action in order to offer fair value gap to both sides of the market. We are starting with the buy side imbalance, sell side inefficiency. This is the example of the buy side imbalance and sell side inefficiency. This means that if they repriced to the buy side too quickly, leaving an imbalance. An imbalance is that space you are seeing between those two red lines. The wick offers both buying and selling in the upward and down movement. The body where no wick overlaps is all buy side delivery and inefficient all sell side delivery. This is an example of the sell side imbalance and buy side inefficiency. Remember, these are classifications of fair value gaps, but we shall also see the types of fair value gaps. These are classifications. We are having the sell side imbalance, buy side inefficiency, and the buy side imbalance, sell side inefficiency. Where we see the reclaimed fair value gap, implied fair value gap, inversion fair value gap, and many more. In this illustration, we are seeing that the IPDA repriced too quickly to the sell side, thus leaving that space in between those two red lines, which we call the sell side imbalance. The body where no wick is overlapping is all sell side delivery and inefficient of the buy side delivery. Fair value gaps are recollected by two ways. We have redeliverance and rebalancing. With me, that is an example, or that illustration is an example of a redelivered fair value gap. Buy side movement has been redelivered back through the sell side imbalance. The inefficient sell side imbalance has now matched with buy side price delivery, offering us a balanced price range of both buy side and sell side delivery. I have told you earlier on, we are having two types of balancing or of repricing to the fair value gap. We have redelivery and we have rebalancing. That is an illustration of a rebalance. When the price passed through this range for the third time and left it, this whole range has now been rebalanced. Any upward movement through this range should be met with strong resistance in a bearish market. Remember also, a fair value gap is having three provisions. We are having the premium, the discount, and then the consequent encroachment. I think let's go onto the order blocks. We shall have a better demonstration of the fair value gap on a real chart. For the sake of order blocks, an order block is a very last opposite candle before an impulsive move to the opposite side. For the bullish order block, the down close candle becomes a valid bullish order block once we close above its high. A higher quality order block will have a fair value gap directly above its displacement. When the price returns to the order block, the most observed part or the most sensitive part is the threshold or the 50% of the order block. We don't want to see price violate the mean threshold of the order block. If the order block is valid and we are in a bullish environment, we shall see a reaction from the order block mean threshold, and the IPDA will reprice higher. Traders note this. High probability order blocks will be formed around the equilibrium level of the consolidation phase or the consolidation range or a consolidation. For the bearish order block, it's just an up close candle that runs buy side liquidity. Then the others remain the same. The threshold remains considerable and everything we have talked on the bullish order block. We have finally come to slide into the charts for a better demonstration. As I told you earlier on, market structure is key. If we can clearly view this, that our institutional order flow was bearish. This is the weekly time frame of the Canadian versus the Swiss franc CAD CHF on the weekly time frame. As I told you earlier on, we are looking at a different perspective, or we are looking at different time frames. This is the CAD CHF. We can clearly see different market structure breaks to the downside, and then later we had to come up with this to know what is our interbank dealing range, as I've been telling you earlier on. Our old high to our old low. Meaning, if we got this interbank dealing range, we are looking up for price either to reprice back to this. After the price repricing back to this premium zone, meaning now we are looking for sales. We can clearly see that the price repriced back to the weekly sell side imbalance, buy side inefficiency, so the fair value gap, and we got the candle closed below the fair value gap or below the consequent encroachment. This is the consequent encroachment I've been talking about. This is what you see labeled the CE. the consequent encroachment. Remember, we told you a valid order block is the order block which is having a displacement. You can clearly see this order block. The price came back to the premium zone so as to mitigate two PD arrays. We had this premium PD array and the premium fair value gap. This is the card CHF on the weekly time frame. After the price repricing back to the interbank dealing range premium zone, then we are looking for sales on our premium PD arrays. And clearly, you can clearly see what transpired. The price came and mitigated our fair value gap. It came and collected orders from this bearish order block, then came back and closed below the consequent encroachment. Everything we are looking at the candle closes below the CE, and on another block we are looking at the candle closes below the threshold. If the candle closes below that, then it's a tick, or you are good to go, you are good to enter the positions. Meaning you as a trader, you are entering on candle closes. After the candle closing below, then you have confirmed. You enter with risk management, and then you are good to go. Let's slide into another chart. This has been card CHF. This is our analysis on Euro GBP. After taking off the sell side liquidity on the old low, meaning we are now formed a new dealing range. After taking out this low, meaning this was our new dealing range, and we took this and this. Now we are waiting for the price, because here the price was in premium. We are just waiting for a reprice of price to back to the discount. When the price came back to the discount, it found our fair value gap. Now this candle closed in the consequent encroachment just gave us a go ahead of the buys. You can clearly see this. Identify your dealing range, wait for the price repricing back to the discount zone or back to the premium zone, then do the needful. This has been Euro GBP. I may be a bit fast, but just bear with me. I'll be making more episodes explaining this. If you have not got it, just comment down in the video, or just comment down on the comments, then I'll be repeating for you, and my inbox is ever open. I think the other I had, was it Euro card on the weekly, I think also. I had Euro card on the weekly. This is it. Now you can clearly see this. We had our old high, then our old low. We had these relatively equal lows, though they were taken out after hitting our take profit. This is it. The price repriced back to our weekly order block, and this is our premium order block. You can clearly see it is on our premium zone. This is this premium zone. I think, let me just put label in some words here. Text. This is the premium. Okay, just put it here. Premium. Then I think I should also label the discount. Oh, how am I writing discount? This discount zone, meaning if the price comes to the discount zone, you are looking for buys, and if the price comes back to the premium zone, you are looking for sales. This is it. Another block is the very last opposite candle before an impulsive move to the downside. You can clearly see here the price came back and we repriced back to our premium. Just put it here. That is our interbank. We repriced back to our premium zone, then we went in for sales. I don't know whether I have a chart which is not on a higher time frame. Let me just look through. Put it GBP USD. GBP USD. Or under. And could we just check on the 15-minute time frame? Reset chart, reset. This could go under. Oh, it's not happening. I think finally I've landed on it. Yeah. That is our analysis on the lower time frame. Buy side liquidity. I told you a new range is formed after taking out buy side liquidity and sell side liquidity. Sell side liquidity lies on the old lows, previous days low, previous week's low, and then the buy side liquidity previous week's high, previous day's high, you can clearly see we took out the buy sell liquidity and then we formed a new range. Then the price repriced back after taking out the hour external range liquidity. Then we went in for buys because they took out our old low. Then we are going in for buys. I told you the price or the IPDA is seeking for liquidity zones. I think with that demonstration, you have now got an insight on how we use the PDRA matrix. More of them, the breaker blocks, the mitigation blocks, the rejection blocks, just comment them. If you don't know, comment on the video below, then we shall be good to go. I'll be making another video, I'll be coming back with another video to explain them more. I promise to be your one-on-one mentor here on YouTube. Just keep locked in the channel, subscribe, don't forget to like and share. Have a blessed day. Forex Giant Uganda.